Good morning. I'm Julie Hyman with Ines Ferre in for Brad Smith. This is Yahoo Finance Live. Let's get right to the three things you need to know to start off your morning. First thing you need to know, Fed Chair Powell's hawkish testimony this week sent shockwaves through the markets. Stocks retreated, yields continue to go higher, with the bond market doubling down on the odds of a U.S. recession. That reflected in the yield curve, which hit its deepest inversion since 1981. And the anxiety in the markets will keep building as we continue to get economic readings, including tomorrow's jobs report. Second thing you need to know, a 25% minimum tax on billionaires and a doubling in the tax on capital gains. Those are reportedly part of President Biden's budget proposal set to be unveiled later today. The budget aims to reduce the federal deficit by $3 trillion, according to reports, plus shore up Medicare and Social Security. But important to note, it's mostly just a wish list. The New York Times described it as, quote, dead on arrival because of the Republican-led House and slim Democratic majority in the Senate. Third thing you need to know, Norfolk Southern CEO Alan Shaw heads to Capitol Hill today to testify about the Ohio train wreck. Lawmakers from both sides of the aisle will call for answers about the derailment that took place in East Palestine, Ohio, which unleashed hazardous chemicals into the community and drew national scrutiny. The CEO will tell the Senate he is, quote, deeply sorry for what happened, and he'll address what Norfolk Southern will try to do to fix it. That's expressed in Shaw's prepared remarks that were released this week. Investors still digesting Fed Chair Powell's hawkish tone on Capitol Hill this week, with stocks retreating and bond yields surging higher. Let's dive into it with J.P. Morgan Global Wealth Management Chief Investment Strategist Tom Kennedy. Hey, Tom, good to see you. Thanks for coming in studio here today. It's been such a whipsaw this year in terms of there's going to be a pivot to a cut later this year. No, there's not going to be that. There's going to be no landing. There's going to be a soft landing. There's going to be... What is there going to be at this point?
Good morning. Thank you for having me. The adjectives being used to describe the economic outlook are just outright confusing. Hard landing, no landings. I think we, number one, have to understand the process of monetary policy, how it works. If you're an investor, though, what'd you get from Powell this week? You said it exactly right. Anxiety, uncertainty. It's quite odd to think about a central banker increasing the pace of rate hikes. That's the new news this week, that Chair Powell could, instead of hiking at 25 basis point increments, potentially move up to a 50 basis point increment. I advise my clients to be long-term investors. What do they do with this new news is certainly think about the anxiety and the uncertainty, what to do about it, but really to zoom out and say, the Fed is along the path to this disinflationary process. And I love that chart you're showing about recession risks are elevated. And if you're a long-term investor, how can you protect your portfolio against that? I think is really an important process to be having the conversation about.
And we'll get to that. How do you protect your portfolio? But what are the signs that you are looking at as far as this sort of restrictive environment that we're in? If the Fed does hike to 50 basis points, right. What are you looking at as far as I take it you're not a no landing person here. Yeah. You're not on the no landing team.
The no landing scenario is really hard for me to understand, because it implies that interest rates can stay at these, what I would call restrictive levels, but growth could still remain at trend or even above trend. The way I was trained, I spent almost 10 years with the New York Fed, that doesn't really coexist for me. But I'm already seeing signs, or my team, that rates are restrictive. Really three important things to look at. In the housing sector, the slowdown has been the fastest we've ever seen, a really important indicator for us. In development of new properties, completions of jobs are now higher than starts. Imagine if you run a construction business, if you complete 10 jobs and you're only going to start 8, there is a team there that needs to be laid off. So that's point one. Point two is that capital is being removed from the system. Banks are tightening their lending standards at really the fastest rate we've seen since COVID, and it should imply capital investment should go down as well. If I can't borrow money, how am I going to do a new project? And then last, on the consumer, which we all think is so strong and durable, they are, but you're already seeing auto and credit card delinquency start to rise from a very low level. So if I'm sitting at the economy, I'm getting the evidence I need that rates are restrictive. It will just take time to really slow the growth and bring inflation back down to trend.
Yeah, really interesting points for people to consider. And then there's also the jobs picture, right? Which lag is a big part of the conversation, to the point you were just making. We got initial jobless claims this morning, ticking up above 200,000 for the first time in I don't know how long. It's been a while since we've seen that kind of a reading. We've got the jobs report tomorrow. I know you said you're long term, but how are you thinking about the jobs market as how it feeds into how you're investing?
These near-term variables are really important because it appears the FOMC is considering them very acutely or in a relatively short window. January saw a surge in jobs. Over 500,000 jobs added is such a rarity in America over the last 50 years. So really what we're looking for is tomorrow we should see job growth slow back down to the trend that we saw in Q4 and Q3 of last year, something like 200,000 jobs. Should that number come in substantially higher? 50 basis point hike looks likely. But should we return to maybe 200,000 or lower, maybe the 25 basis point increment matters. The bigger zoom out though, again, for my clients, I think is most important. The trend should be slowing job growth. The real challenge of this economy is the labor market is just too tight. And when people are realizing, regular folks, wage increases and higher earnings, they're going to spend. And it's hard to see inflation come down to 2%.
So how do investors position their portfolios in this scenario?
I think you have to recognize this is a late cycle environment. What is the Fed trying to do? By definition, is slow growth. For companies, for investors, that means expected earnings for corporations should slow. And that means interest rates are high. By definition, to slow growth, I want to capture that in my portfolio. I want to be long bonds. And for the last 15 years, these have been boring, unsexy ideas. I don't think they're that at all. I think they're actually quite opportunistic. Can lock in a 5% yield for 5, even 10 years. I want to take advantage of that while I can.
I'm also curious, since you're on the global wealth management side, you're seeing it, obviously you're looking at the markets and making judgments, but you're also hearing from your clients.
Absolutely.
Some of whom are at the upper wealth end of the spectrum. How are they feeling right now? Because we've talked a lot about how lower income consumers are maybe going to feel the pinch.
Yeah.
Are upper income consumers feeling the pinch?
I don't generally think of my clients as feeling the pinch the same way a lower income consumer might feel. But what I do get great insights from them is about their own businesses and what they're seeing and feeling. And in parts of America, you're actually seeing a notable slowdown. In other parts, maybe not so much. And I think in our brains, we can think of what those places may be. But it shows you that the recessions don't hit everyone exactly at the same time, and they're felt unevenly across geographies. The mass migration that we saw post-COVID has moved supply and demand imbalances to different places. So this quarter, or in 2023, is the first time I've really heard them talk about a slowdown. That's meaningful input for me.
Really interesting. And for us now, as a result.
Right. Tom Kennedy, Chief Investment Strategist at JP Morgan Global Wealth Management. Thanks so much for joining us, Tom.
Thank you.
Thank you. President Biden is set to unveil his budget proposal today, which will reveal his plans on the billionaire tax, Medicare, and Social Security. For more, let's check in with Yahoo Finance's Rick Newman. Rick.
Hey, guys. Well, I think Julie nailed it before when she said Biden's budget is not anything that's actually likely to pass Congress. It's going to be pretty familiar to anybody who paid attention to Biden's Build Back Better plan when he first got elected. A lot of those items are in this budget as well. More social programs, free community college, expand the child tax credit, raise taxes on businesses, and raise taxes on top earners. Now, none of that has any chance of passing because Republicans control the House of Representatives. And let's remember that even Democrats couldn't pass most of those items when they controlled both houses of Congress. But in another sense, this budget is important because it sort of begins the process of Democrats and Republicans figuring out how we're going to get to the point of raising the debt ceiling when there's no choice, which will come at some point in the middle or the end of the summer. So the way this works is first Biden releases his budget, then Republicans release their budget, which is going to be very different. It's going to call for tons of spending cuts, probably in Medicaid and programs for the poor. And now they have that. Those are sort of the framing points. We've got one parameter and the other parameter, and that's where the negotiations start inside of those two parameters. So perhaps this will get us to the point where we can raise the debt ceiling and stop worrying about that. But it's going to still be several months before that happens.
Yeah, and of course, we talked to Maya McGinnis for the Center for Responsible Federal Budget yesterday, and she said the two things shouldn't even be related. But unfortunately, we live in the world of is, not should, But do we have any idea the areas where there could be some agreement? I mean, it seems like a 25% billionaires tax is not that place, but maybe there are some others.
Right. So I think the essential question is, how do we get to the point where there is something that looks like a compromise that that the Republicans can sign off on and say, okay, good enough. we agree to raise the borrowing limit, that probably is going to look like very modest spending cuts that will at least let Republicans say, we got some spending cuts. There could be another way out, which is let's establish a commission that is going to look at possible big spending cuts in the future. And then there are legislative maneuvers which might allow Democrats who just want to get this whole thing over with and raise the borrowing limit and stop worrying about it to get that done. So there are a bunch of different ways this could go. And unfortunately, this is going to go down to the wire because Republicans have just dug in their heels, and they, the way these things go is you think you don't have maximum leverage until you're about to cause maximum damage. So there's going to be a white knuckle moment here, probably again midsummer, late summer, and good chance we will get to raising the borrowing limit and get past that, but not a certainty.
And we've talked about this before, but just to remind folks, Rick, what do the markets tend to do as we get closer and closer to this debt ceiling limit without that agreement?
The template for this is what happened in 2011, when we literally went down to hours before the Treasury Department would be unable to pay some of its bills. And what we saw then was markets started to get shaky about 3 to 4 weeks before that deadline. And the S&P 500, I don't have the exact numbers in my head at the moment, but it came down something like 15% leading into that debt ceiling showdown. And then Standard & Poor's cut the U.S. credit rating for the first time ever by 1 notch. And stocks took 6 months to get back to where they were before the whole thing happened. So that is perhaps, the worst case scenario would be an actual default on U.S. debt. So assuming that doesn't happen, the worst case scenario is probably what happened in 2011, which is a significant drawdown in stocks leading up to the actual deadline, and then a period of months before stocks ever bounce back.
Yeah, it was a big decline. I remember it well. So hopefully we don't get a repeat of that, to your point. Rick Newman, thank you. Appreciate it.
Hi, guys.
Bye. We're going to have more coverage of President Biden's budget proposal in the 11 a.m. hour today with the National Economic Council's Deputy Director. Norfolk Southern in the hot seat today as the company looks to get back on the right track following its February 3rd train derailment, which resulted in a toxic chemical spill that led to the evacuation of East Palestine, Ohio. The rail company's CEO, Alan Shaw, he's set to testify today before the Senate Environment and Public Works Committee on Capitol Hill. We'll be following this story closely all day here at Yahoo Finance, including conversations with a former U.S. Environmental Protection Agency official and the president of the Smart Transportation Division. You don't want to miss that as we track that hearing.
Hoping for interest rate cuts? Think again. After Fed Chair Jerome Powell's comments to Congress, the bond market is pricing a steeper path for monetary tightening by central banks. But what does this mean for the long term? You can read all about the latest in today's morning brief written by Jared Blickery over at the Yahoo Finance homepage. Jared joins us here live in person.
Yes, everybody wants to know soft landing, hard landing, or the ridiculous no landing, which probably just a delayed recession because you're going to get one eventually. But is it off the current economic slowdown that we're kind of watching in slow motion in some areas and not even seeing in another? We were just talking with the JP Morgan's wealth strategist about some of the comings and goings in the labor market. Construction jobs are very hot right now. More on that in a second. But first, I want to get to the bond market's reaction here because there was a steep rise in the 2-year yield. In fact, it surged north of 5% for the first time since about 2007. I think it hit 5.07 or so, and it has surged above the 10-year yield. So here I have going back to the beginning of the pandemic 3 years ago, the U.S. 2-year yield in purple, 10-year yield in blue, cyan, and then the spread between them. We first got an inversion about the middle of last year. That's really when it started heading south there. And now it has reached a negative 100 basis points. That is the lowest amount since about 1981, 1982, when Volcker was fighting inflation. And let me just get you to another picture of what happened with the entire yield curve. This is the yield curve from 1 month, 2 months, 1 year, 5 year, 20, 30, the whole gamut here. And you can see in this blue line, this is before Powell, it shifted up to after Powell, at least on the short short end of the curve, especially in the realm of the 1 and 2 year tenors here, and those shot up 17 to 18 basis points. What that's saying is the Fed is going to raise its rates to a higher level than previously thought and keep them there for a bit longer than expected. And what's happening is all those rate cuts that were priced in for about the first half of next year, 2024, those are getting pushed down the line. So this sets up a very unrealistic scenario. We were just interviewing, Julie, you and I interviewed Alfonso Picatiello of the Macro Compass, and I was using some of his work. He says this creates a credibility issue for Powell. The market finds Powell so credible that they are pushing out these rate cuts in an unrealistic fashion, because when we see a crack in the jobs market, when we see an earnings recession, which we may be in right now, that creates additional pressure on the Fed. What the Fed does is usually cut aggressively. So the more we hike in the short term and think that Powell's going to keep these rates for a long time, the more cracks we're going to see potentially and the harder landing we're going to see down the line. Now, I just want to show a couple charts here. First is the B of A, ICE B of A Move Index. This goes back 6 months. This tracks bond market volatility. What I want to show you here is since the beginning of February, we've seen a sharp increase. Now, when we see increased bond market volatility, that weighs on stock prices because it reduces leverage in the system. So we have really kind of given back a lot of those January gains. Finally, I want to leave you with a thought about the labor market here. This is S&P 500 futures this morning on the jobless claims that aired on the hot side. That is, we had more people unemployed filing jobless claims than expected. That's a bad number. We got a huge increase, not a huge, but a pretty big spike here on that news. What that tells me is that good news is bad news and bad news is good news in the labor market. This Friday, we're talking about those construction jobs. Those are usually the first to get hit in a recession. So I'm going to be watching that number like a hawk. If we do see a big drop on Friday or in the coming months, probably the beginning of that long-awaited slowdown. So we'll have to wait for that, guys.
Yeah, and a really interesting stat that Tom Kennedy of JP Morgan just talked to us about was that completions of construction projects are outpacing starts.
That's key because a lot of people have jobs right now and are not going to have jobs in the future. Employers have been front-loading this and keeping employees. Commercial real estate is picking up the slack, but that can't last forever.
An important jobs report tomorrow. Thanks so much, Jared Blickery. And as the markets digest Powell's recent comments, investors are wondering what's in store for growth and inflation going forward. Joining me now to discuss is Bonnie Wong-Trakol, portfolio manager at Western Asset. Bonnie, thanks so much for joining us. You heard Jerome Powell's comments yesterday, not on a set path. The Fed's not on a set path, data dependent. We are waiting for that jobs report tomorrow to give us a better picture of what's happening. But what should investors be making of the current environment right now and what's expected over the next 6 months or so?
Yeah, so I think investors really need to ask two questions. And the first one is really, what are current rate levels implying for growth and inflation going forward? And the second is, can the U.S. economy really deliver what's being implied by the market? So we view current rate levels as projecting very robust growth and inflation that's going to be sustained over the year. And those numbers we saw in January were indeed very strong. But when we think about the prospects for the economy to continue along those levels, we are a bit circumspect about that data in January. I think it's been well discussed that there was warm weather, seasonal adjustments, there were cost of living adjustments. We even had mortgage rates dip towards 6%, and now they're closer to 7%. So all of those are idiosyncratic and one-off. But alongside that, we have seen that manufacturing has been slowing down, arguably has been in recession. So has residential construction. Now we're seeing the consumer become more cautious and savings rates go up. So all of this is leading us to believe that growth is going to moderate over the coming year, along with inflation. Of course, we are going to get a lot of very important data over the next few days between employment data. Tomorrow, we have CPI and retail sales next week. So we will be looking at those really closely to help us fill out the picture more.
Bonnie, it's Julie here. So if indeed January was a bit of an anomaly and we are going to see some moderation in growth in inflation as well, what should the bond market look like? What should the yield curve look like right now if indeed that is going to be the case?
So if we're seeing that growth is going to moderate, then clearly the longer end of the curve needs to come down. That is an area that we like, longer dated maturities, because that is going to reflect the longer term growth and inflation prospects. And we've seen that the 10-year does have some interest and support at that 4% level. We think that does make sense. On the shorter end of the curve, there is going to be some more volatility. There is going to be a lot of data that the Fed is going to be looking at over the next couple months. I don't think anyone can really say whether they're going to get to what's priced into the market, not the Fed themselves. So on that area of the curve, we recognize there is upside risk. We think there's going to be volatility, and we would prefer to be underweight that part of the Treasury curve.
And following up on that, I was going to ask you about what your views are as far as investments. I mean, how should investors be positioned in this environment?
Yes, well, outside of Treasuries, I just talked about our Treasury view. Outside of Treasuries, we still think that corporate credit makes a lot of sense. The fundamentals are still good. From a bondholder perspective, interest coverage is very strong still. And so we still like being overweight that asset class. And there we do like being shorter on the maturity curve. You can get very good all-in yields 5 years and in. So investment grade is offering 5.5%. And for below investment grade, it's 8.5% around that area. So we think that's quite attractive. In addition to that, we do like emerging markets, which we think could benefit as the Fed hiking cycle starts to wrap up, as you see the US dollar normalize, which could also benefit from the China reopening, particularly for countries that are exporting tourism and commodities. So we do like that sector as well. And for the investors that have the risk tolerance, we really do like frontier market sovereigns, which are these smaller, below investment grade rated emerging market countries, which have issuance in US dollar denominated debt and offer actually double-digit yields.
Bonnie, switching gears for a second, because all of this strategy flows, at least in some part, from the Federal Reserve and the decisions that they make. And reports out this morning suggest that Janice Eberly is the front runner to be nominated for vice chair of the Fed. You've written a little bit about this. If indeed that's the case, if indeed she gets that position, what does that mean for Fed policymaking?
Well, she's clearly very well qualified. We have to see how the rest of the Fed is going to work with her, but we would look forward to her leadership if that confirmation does indeed go through.
And if she is indeed going to go through, it's interesting as we think about the Fed, because obviously they speak with one voice on decision days, right? When they come out with their policy, when it's Jerome Powell who does the press conference. But in between that, we get a lot of Fed speak, and the market has been very reactive to that Fed speak. So is there anything we can sort of extrapolate on that basis if she does get this position?
I think you're going to continue to see a variety of voices within the Fed. I don't think that her addition is going to change anything. And I think Powell does a good job of bringing together those voices. But yes, you're right. We do see a variance in opinions. We've seen the Fed speakers kind of evolve their thinking as the data has evolved, and we don't expect that to change, as the Fed is going to be very reactive to each data point that comes in.
Yes, it will. And so will we. Thanks so much, Bonnie. Appreciate it. Western Asset Portfolio Manager Bonnie Wong-Trickle, appreciate your time this morning. Coming up, Etsy getting hit with a double downgrade. We'll discuss that and have the opening bell on Wall Street next. Time to check on some movers right now. And let's start with Asana. Those shares are up 15% after the company reported a narrower than expected loss. But importantly here, the founder and CEO says he's going to buy up to 30 million shares in the company, which is obviously a big vote of confidence here, as the company did also report that loss that was only 15 cents versus the 27 cents estimated. Revenue came in ahead of estimates here, and the company's forecast is also coming in ahead of estimates. This is a company that makes workplace software or sort of organizational software as well. It's interesting here that he's coming out and making this this move. Dustin Moskovitz is the CEO.
Yeah, and just taking a look at some of the comments from Wall Street, you've got KeyBank Capital Markets that basically said that CEO share repurchase is one of the most important announcements, and it is a strong vote of confidence when it comes to buying back or buying those shares. And in fact, also taking a look at some of the comments that the CEO had made, he's saying that given the scale and the opportunity that he sees in front of them as far as the company is concerned, he thinks that the shares of Asana are undervalued. But Oppenheimer coming out with some saying that that Asana had some solid results in its last quarter with a price target of $28 a share, and Piper Sandler also has a neutral rating on the stock, but talked about outside exposure to the technology vertical that could make a near-term drag on growth into the second half of the quarter. So,
I mean, this company is badly in need of a boost, I think we can say too. I was 100%. Just looking back, like so many of its peers in enterprise software, it peaked back in November of 2021. And stocks are down to varying degrees since then. This particular one, down about 87% since that time. So it has really just collapsed since then. Like many of its peers as well, it has rebounded this year. It's up about 29%. But nonetheless, it's so fascinating if you look at that longer term chart, how far it still has to go to even come close to reattaining the levels where it was.
It's not out of the woods. It's not out of the woods. Analysts are seeing some headwinds in the first half of the year for Asana.
Yeah. But we're seeing that bump here in this morning session, and sort of reflecting the enterprise software trajectory that we've seen generally. I mean, what I find so interesting about this group, Inez, is that we have seen the rebound this year. We've had a number of guests recently coming on talking about rates remaining high, talking about the environment remaining tough for growth. And you have to wonder how sustainable some of the rebounds, some of the bounces, some of the reflexive pops in these stocks are going to be.
Yeah, I mean, XLK is up more than 10% year to date. You've got communication services that's up. You've got the growth names that are up this year, year to date. But you have to wonder about some of these companies, some of the software companies as well. I mean, we have seen a rebound with them. And it just also depends on what other companies are spending when it comes to software.
Right. And of course, we've got the whole old saw about it being a stock picker's market right now, too, that they're not all going to trade together. But to your point, the XLK and communication services, the two best performing groups this year. There's a little dissonance. There's a little disconnect here between that and then what we're hearing from a lot of macro people. But we'll see what happens. There's the opening bell on Wall Street, our coverage sponsored by Tasty Trade as we get the bell this morning. A lot of yellow there on the... It looks like a new listing there on the podium this morning as we get underway. And, we got initial jobless claims this morning coming out higher than estimated, i.e. worse than estimated. You had yesterday an ADP report showing more gains in jobs than had been estimated, and all of this ahead of the jobs report tomorrow. So it feels once again today like maybe we're in a little bit of a holding pattern as investors look for more information in tomorrow's jobs report and try to figure out where we're going next in terms of the economy and rates, Inez.
Yeah, we are in a holding pattern right now. We're looking at the Dow that's up more than 135 points. I'm going to pull up a two-day chart here because there's a lot of blankness there, but you can see over the last 2 days the action there. The Nasdaq Composite today, it's relatively flat, up just 13 points, and the S&P 500 just around that 4,000 level that everyone is talking about. Taking a look also at the sector action to look at to see where we're at with energy stocks. Those are the leaders. Industrials are also leading. You've got financials, which have been under pressure over the last several days. Real estate also under pressure. And looking at the Dow components, we're watching Merck that's up. American Express also up as well, and Microsoft is higher. Over on the Nasdaq, want to point out one of the Nasdaq movers, well, Tesla down 0.3%. I'm going to pull up a 5-day chart over here for Tesla just to take a look over the last 5 days, down 5%. You can see over the last 2 days down more than 3%. Tesla being investigated by regulators as far as their steering wheels on some of the SUVs, and if those steering wheels come off, also regulators investigating crash involving Tesla. So that may be what part of the reason why you saw the stock lower yesterday. Today, just hanging around the flat line, down 0.7%. And then finally, just looking at the Chinese ADRs, we are seeing a little bit of pressure there. We've got Pinduoduo that's down, JD.com down 8%. So quite a bit of pressure on these Chinese stocks, Julie.
Yeah, and JD came out with its earnings as well today. It looked like the revenue was pretty much bang in line, but I'll have to dig into the numbers a little bit to find out what missed. Obviously, something missed there. Let's also talk about some other movers here. We've got BJ's Wholesale Club. That stock popping after reporting a beat on the top and bottom line. It said it achieved a record 90% tenured member renewal rate in the fourth quarter. The shares are moving higher. Like, many of the companies that cater to consumers who are trying to save money, this is a company that seems to be benefiting from that. If you look at the comp sales, excluding gasoline, up 8.7%, much better than what analysts had been estimating here. Our inventories also climbing less than had been anticipated, and membership fee income up 8%. So overall, performing pretty well.
Yeah, that membership income up 8%, that's significant because membership fees tend to be going straight to the bottom line. I mean, this is something that's also positive for Costco as well. But just taking a look at some of the comments that were said by the Chief Financial Officer, Laura Felly, saying that looking ahead to fiscal 2023, that they have the understanding that there are still significant uncertainty in the macroeconomic backdrop as well as its influence on the U.S. consumer. So certainly keeping in mind the consumer, which has gravitated and did gravitate during the pandemic as well to big box retailers getting more in bulk, making less trips to the store. And now it's about inflation and about getting more value when you go shop, and buying in bulk is better.
Well, and we heard from Costco that they suffered a little bit from people not buying as many discretionary items at the stores. I frankly don't know the product mix at BJ's, if it offers as many as those like giant teddy bears and sort of, cool items like Costco does, but it does not seem to be necessarily suffering from that. If you look at even their forecast for the full year, for the fiscal year, they're looking at comps ex gasoline to be up 4 to 5%, membership fee income, to your point, an area that goes straight to the bottom line, up 5 to 6% year over year, and merchandise gross margins to rise about 40 basis points. At the same time, BJ says earnings per share are going to remain about flat year over year. One more thing quickly I just want to mention, since I just did mention Costco and we talk a lot about Costco, just to put these two companies in perspective that compete against each other. BJ's has about 237 clubs. I believe that they are all in the United States. Compare that with Costco, 848 locations, 584 of them in the U.S. So Costco, a much bigger operation, obviously, but BJ's, it looks like, doing well in this environment.
And speaking of discretionary items that you were just mentioning, shares of Etsy under pressure after a double downgrade from Jefferies as they see downside to consensus from slowing top line and moderating margin expansion. Double downgrade, which, by the way, includes a price target now of $85 compared to $150. So quite a haircut there for that price target. Look, this is a company that during the pandemic had done really well. People selling masks, handmade masks that you could buy on Etsy. The year-over-year comparisons are tough for Etsy, and it has had to contend with that. It also has had to contend with the issue of the stronger dollar, and just the economic volatility that we've been seeing. But really, the discretionary items that do you really need the crafts that are made on Etsy?
Well, and it's not just crafts, right? They have a lot of secondhand items. They have other items as well. Initially, they had kept up the momentum from the masks, right? From the post-pandemic period. They had kept up a decent amount of momentum, repeat buyers coming back. That now seems to be fading. At least that's the case that Jefferies is making. The buyers are churning faster. In other words, people aren't necessarily coming back. They talk about habitual buyers down 9% year over year in the fourth quarter, which is something that is relatively unusual. Buyer spending moderating sequentially each quarter of 2022. And so now Jefferies says the company is having to spend more on marketing to keep those buyers coming back. And so they say that's going to be a problem for EBITDA. Just to take a step back, there's also, of course, a recent short call that was made regarding the company from Andrew Left over at Citron. His case is sort of completely different. He talks a lot about what he says are counterfeit items on the site. That does not figure into this call today. This is more on the existing business, but still, there's definitely some downside pressure on the company.
Yeah, you still have 15 buys and 11 holds and 1 sell on the stock, or 2 sells on the stock. So you still have quite a bit of bullishness, but this double downgrade making an impact on the stock right now as we see that it's down. Coming up, Silvergate Capital is announcing an orderly wind down of its banking operations. We've got the details next. Stay with us. Silvergate Capital has announced an orderly wind down of its bank operations after the collapse of crypto led to the loss of billions in deposits from digital asset customers. Yahoo Finance's David Hollerith has the details. David, so what does this mean for Silvergate and also for the rest of the industry?
Yeah, it has. It's a good question. I think one place to start is that Silvergate doesn't directly impact retail investors. So Silvergate's this is more so affects crypto-related businesses and also institutional investors. And it's an orderly liquidation, and it hasn't been proven yet or clearly stated whether or not that means a bankruptcy or a receivership, which is sort of a bank situation in this case. Silvergate Capital is a holding company, and Silvergate Bank is a FDIC insured bank. So we could see both of those in parallel or either one or the other. Depending on what Silvergate chooses. But it's important to point out that Silvergate made this voluntary decision for liquidation. We're not really sure about what the discussions have been like over the past week. We do know that the FDIC, which technically isn't the regulator, but more so the insurer for Silvergate, has been at Silvergate headquarters since last week. What else we can point out here is that the company plans a full repayment of all deposits, which is obviously much cleaner than what we've seen with crypto firms filing bankruptcies themselves recently. So I think that it's important also to point out that Silvergate's situation was definitely a result of what happened in Q4 with the collapse of its major client, FTX. But ultimately, sort of what has led to its downfall was the drop in total deposits. And clearly, this comes from their largest client depositors having been crypto firms. But it also speaks more to not having a diversified banking business, and also to the fact that what happened was that when all these deposits were pulled out, Silvergate had to sell securities and debt so that they could give those customers their cash back. And in that scenario, it seems that they had to sell their securities at a loss. So they weren't necessarily holding high risk investments, but just from interest rates over the last year through 2022's hiking cycle, it's meant that they had to sell at a loss. And that kind of risk has sort of been crystallized now. And as a result, that's what we're seeing here. For crypto, it means the end of a crucial banking partner. A lot of firms pulled out last week. I have not spoken to any crypto firm that has admitted to still having Silvergate exposure. So again, the company says its plans to return all deposits. So at this point, the liquidation is orderly, but we're going to watch to see if this is going to impact other banks that work with crypto businesses to any large extent. So that's definitely the next thing to watch.
Well, and in just even more broadly than that, David, as we look at this collapse of this bank, it just has to lead me to wonder whether the ripple effect from FTX is over, right? Not just whether this bank's collapse affects other banks, but whether there are still sort of like some repercussions from FTX that are still echoing through the system that we haven't necessarily seen yet.
Yeah, I mean, I think that's entirely possible. In terms of the connections that FTX had, that bankruptcy is huge, and there are hearings every week on it. And as recently as Monday, FTX came out to sue Grayscale for their digital assets as a way to get more money for creditors. So, we haven't even seen clawbacks yet for FTX, and that could be huge for not just for other companies, but also politicians and nonprofits that FTX has donated to. So we'll definitely watch that. And obviously clawbacks take a longer time, but that's going to be a big one that the FTX bankruptcy will be focusing on.
Yes, I'm sure you'll be diving deeply into that over time. Thanks so much, David. Appreciate it. And a mover to flag for you, from a crypto bank to a tech one, namely Silicon Valley Bank. It caters to venture-backed tech and life sciences startups. Shares of its holding company, SVB Financial, are plunging, down 34%. The company said it's raising $2.25 billion through a three-part share sale. The first, $1.25 billion in common stock to investors. The second, $500 million in convertible preferred shares, which shouldn't ideally be as dilutive, and $500 million directly to private equity firm General Atlantic. All of that, and concern about funding overall, is what is tanking those shares today. Coming up a little bit later, stay tuned for our conversation with Grayscale CEO Michael Sonnenschein. He'll be talking about the state of crypto and, more specifically, the company's ongoing quest to try to get its trust converted to an ETF. Coming up next, though, cybersecurity firm CrowdStrike is providing an upbeat outlook for investors. We'll talk to the company's CEO. Cybersecurity firm CrowdStrike gave investors a positive outlook for the year to come as it moves forward with its plans to target small to mid-sized businesses. CrowdStrike CEO George Kurtz is with us right now. George, it's great to see you. Last time I saw you, we were in person in Davos. Nice to see you virtually this time around. Let's talk about demand for cybersecurity right now, because as we talked about a couple of months ago, you said we're not going to see huge cutbacks in cybersecurity. Clients are prioritizing that. What more can you tell us about what you have been hearing from your clients?
Well, cybersecurity is something that you might be able to pause, but you can't put off indefinitely. And that's absolutely what we've been seeing. A lot of certainly large organizations have prioritized security into this year, financial year 23. And once they have those projects prioritized, it's very difficult to move them around and restart those. So we certainly saw that at the end of the year and the beginning of the year in January. And I think it really goes to the fact that security is so critical to organizations in helping them become resilient and protect them against some of these devastating attacks that we've talked about in the past.
And George Ines here, you're also targeting small and mid-sized businesses. So talk to us a little bit about that. What are you seeing in that space?
Sure. Well, the great thing about our Falcon platform is that we cater to the largest enterprise all the way down to the smallest SMB businesses. And because it's a SaaS service, it's the same technology and it protects the largest organizations to the smallest little companies. What we see in that area is a very fragmented SMB market, and we believe we have the best technology to take advantage of that fragmentation. Even small businesses obviously are going to need to be protected. And now we've actually partnered with Dell, which we're really excited about. We announced that last week, where we're actually going to be shipping on Dell boxes for small and large businesses. We'll also be part of their offering in their managed service. And Dell sellers will actually be able to sell Falcon subscriptions up and down enterprise through SMB. But SMB is absolutely a focus for us.
George, at the risk of seeming like a goof here, I'm going to ask a very rudimentary question, which is, we know you do cybersecurity. Specifically, where do you sit in the cybersecurity landscape, and what exactly do you guys do? We're just trying to break down things a little more here.
Well, it really is a great question, because when you think about cybersecurity, it's a very complicated area. And as I've said before, cybersecurity actually parallels the slope of the technology curve. So you have to be very specialized in how to protect new technologies. We focus on endpoints, your computers and laptops and servers. We focus on cloud workloads, so any of your workloads that are in the cloud. We focus on protecting data. We focus on ingesting data and logging information. And essentially, there's a new marketing term, I guess, that's in the industry, XDR, which is really the fusion of pulling all that data together and then helping organizations not only detect but prevent against these very devastating attacks.
And George, we've talked a lot over the last couple of days about Fed plans and about the 2 and the 10-year curves getting steeper and what this means for the possibility of a recession, or if we're in a recession. So I guess my question is, in the case of a severe downturn or recession, I mean, how recession-proof is cybersecurity?
Well, I think it's very resilient. Security is, again, as I said earlier, you could maybe pause it for a small period of time and try to make do with what you have. But at the end of the day, you can't postpone it indefinitely. And organizations are looking to protect themselves. There's mandates from the board. There's compliance mandates. And it certainly is a resilient industry, which is really important. What we've seen is that budgets are modestly up in some cases, other cases flat, but we haven't really seen security budgets go down. And what's important from a CrowdStrike perspective is, as a consolidator with our platform, we're able to consolidate multiple agents. These are the software programs that run on the computers, multiple technologies, reduce overall cost, give a better outcome, and actually help organizations constrain their headcount growth, because we can offload a lot of that heavy lifting to CrowdStrike.
I also wanted to ask you about the government's new plan, where it talks about putting more of the burden of cybersecurity on companies. Do you think that that's the right approach?
I think it's a shared responsibility. Certainly, when you think about how the government operates, the government is protecting its own interests, which that's the way it works. And organizations that are private organizations have to protect themselves, which is really why there's such a robust security industry. And it is a shared responsibility. There's a level when we think about software as in general. When you look at Microsoft, there was 30 zero-day vulnerabilities. So there's a shared responsibility in making sure that software like Windows is actually safe. And also from a consumer perspective, if you're implementing technology, you want to make sure you have the best. And from a government perspective, it's understanding the threats and making sure that those threats can be communicated very quickly to the private sector.
CrowdStrike CEO George Kurtz, thanks so much for joining us.
Thank you.
Another story we're watching, drama continues to manifest for AMC 1 week after the theater chain reported its 14th consecutive quarterly loss and 4th straight year in the red. CEO Adam Aron tweeting on Tuesday that AMC has been on the threshold list for more than 3 weeks. But what exactly is the threshold list, and what does it mean for the company and investors? Our own Jared Blickery is here to break it down for us. Jared?
Yes, a couple of definitions that Adam Aron is throwing us at, or at least some technical terms. terms that he's throwing at us: threshold lists and FTDs. And let's get to the first definition, and that would be threshold list. Now, this is going to be a little technical, and I will back up and we'll get to naked short selling in a second here, but this is companies whose transactions have failed to clear for 5 consecutive trading days at a registered clearing agency. Now, when you buy a stock, it has 1 day to clear. When you short a stock, it has 1 or more days to clear. It depends on where you are historically. But sometimes there are fails to deliver. And a fail to deliver is when you don't have the ability to prove that you borrowed the stock legally before you actually shorted it. So this gets to naked short selling. And naked short selling of a company is shorting a company stock that has not been affirmatively determined to exist. Now, most of the time it's illegal. If a hedge fund releases a short report on a stock, they can short it, but they have to pay a borrowing fee. They have to borrow it from somebody so they don't engage in naked short selling, which increases the amount of shares and the float of the company. Now, market makers like those at the New York Stock Exchange, Citadel is one, they can engage in naked short selling, and it's perfectly legal. It's part of their market making duties to provide liquidity for a stock. But all of this is coming ahead of a very important date for AMC, and that is next Tuesday, March 14th, when a special meeting of the shareholders going to determine if they should raise their authorized shares. That would be the ability to sell more shares, incorporate some of those 8 preferred shares from about 424 million to 450 million. Also going to be putting on the ballot a reverse split, potential one, of 10-to-1. So whatever you own right now, if you own $5.79 share, if you own 10 of those, you're going to own one, but it's going to be valued $57.90. So the math works out that you're not making money, losing money, but it does increase the share price, because when companies get into the position that AMC is with these big highs here and now these lows, the danger is if it drops below $5 per share, that has important implications. If it drops below $1 per share, that has important implications. They don't want to become a penny stock. So on the back of all of this, Tuesday going to be the day to watch for AMC. I put our 5-year chart here so we can see the GameStop. What I would point out is all these peaks are lower and lower and lower. So we haven't seen the amount of bang for buck that we got in the initial GameStop, but we also haven't seen a spike this year. So maybe we'll get something in the $15 to $20 range. Hard to say.
This is what apes are always talking about online.
Yes.
Thanks so much, Jared Blickery. Coming up, Norfolk Southern is in the hot seat today as its CEO prepares to testify on Capitol Hill. We'll continue our coverage next. Stay with us.
Welcome back to Yahoo Finance. I'm Julie Hyman alongside Ines Ferre. Let's take a look at the latest market action. Investors trying to price in the likelihood of higher interest rates. We've got the jobs report tomorrow. And all three major averages are actually trading higher right now. All of them up in the neighborhood of 0.4%, except for the Nasdaq, which is up more, about 0.6%. I'm also, of course, watching bond yields today as we continue to see them trade near 4%, but a little bit of a pullback today. The 10-year note, little change at about 3.96%, but the big push that we've seen recently, and 2 years still above 10 years. So again, that recession indicator that we've been talking a lot about. Let's also take a look at the sectors within the S&P 500 to see what's on the move most today. Financials continue to be under pressure. As we've been discussing, when we see that yield curve inversion, it puts pressure on what's called the net interest margin at the bank. So it looks like that could be why those stocks are under pressure today. On the flip side, energy, which has been pulling back as of late. There we go. There's energy up about 1.4% today. This is a group that has been flagging this year after, of course, being the big winner last year. So now flipping today. And also we are watching tech stocks that are showing some strength in today's session. So that is what we have been watching pretty closely. Quick check on the Nasdaq 100. We looked at it at the open, now looking at it again and seeing quite a lot of green on the screen there. As we talked about this morning, we did have a jobless claims number that maybe shows a little shakiness in the narrative of the very, very strong jobs market. It came in higher than estimated, maybe a little relief on yields. I don't know, but it feels like much more is riding on the monthly jobs report tomorrow. Norfolk Southern CEO is facing the U.S. Senate Committee on Environment and Public Work amid scrutiny over last month's train derailment in East Palestine, Ohio. Will the turmoil of recent events be enough to alter the trajectory for U.S. rail infrastructure? Here to discuss is Joseph Schofer. He's Northwestern University professor emeritus of civil and environmental engineering. Thank you for being here. So I know that's a big question to kick it off. But I guess first I would ask whether you think there need to be fundamental changes in rail infrastructure. Was this some sort of wake-up call for the industry, Joseph?
I think it's a wake-up call. I mean, this is a real disaster. On the other hand, keep in mind that no one was killed. It doesn't look like the environmental consequences are all that serious. And my concern going forward is, what are the causes? What's fundamental here, and what should motivate changes? As I watch the news coverage, it looks like every politician from the local level to the federal level is trying to jump in front of the camera and say, I'm going to save your lives. But we really don't have a good sense of the scope of the problem and whether what we're seeing, particularly the several events in Ohio, are in any way connected. My sense is they're not connected. The railroad industry has a motivation to take care of its infrastructure because its livelihood depends on that infrastructure, and they have a variety of strategies for doing that. Can they do better? I'm certain that they can do better. I'm certain that there are opportunities for better use of technology, more investment in safety and in the workforce. But right now they tend, particularly the Class 1 railroads, the largest railroads in the nation, are very much driven by Wall Street and by the pressures to keep their operating ratios low, which means to make a bigger profit. And there needs to be some balance in that. I think that this incident is getting people's attention.
Joseph, Ines here. And so what do you think should this investigation look like? I mean, what are some of the questions that need to be asked to get to the bottom of what happened and whether or not it was preventable?
I think it's very straightforward. I think it's a matter of answering the question, what was the cause, or what were the precipitating causes? I don't think we have a full answer, and then we have a partial answer on the Palestine event, but not yet on the other events. My concern is acting too soon. That is, everyone trying to jump in and saying, I'm going to solve this problem, when I don't really quite know what the problem is. It looks like there may be an opportunity to add some detection capability to detect overheated bearings or other kinds of anomalies in the rail system. But my guess is, based on looking at long-term trends in derailments in particular and railroad accidents in general, is that I don't really see a crisis here. I see a need to respond to this and to make sure this doesn't happen. And in the long run, I think the railroads need to rethink their workforce strategy. That is to assure that they have a sufficient number of employees. And that's a problem because they've tried, but they haven't had great success in recruitment. And part of that is these are difficult jobs. And while they pay well, they're difficult and they're dangerous, and the working conditions need to be adapted to attract a 21st century workforce.
Well, and to that point, of course, the railroads have been fighting with their unions, right, over the past 6 months or so. Among other things, the folks who work for the railroads want more flexible sick leave policies, et cetera. Is that at odds with the push that we've also seen from the railroads over the past few years for efficiency, right? For,
yes,
so how is that going to resolve?
Well, it's going to resolve because this is a typical labor management conflict, and it has to resolve because the railroads need the workers to function. They're moving more toward automation. I think that's probably in the long run inevitable and probably a good thing. But there needs to each party in this dispute needs to find a compromise. The working conditions are a challenge, and some of the railroads are experimenting and trying to do better. I think people that are looking at the industry from the outside, including me, are saying, yeah, you guys, you can do better. These working conditions are not good. You can look at what other people have done in the logistics industry. There are examples of developing a better balance and treating employees better. The stories that I'm hearing from the railroads is that they're desperately trying to hire, and they're not finding the people that are willing to accept the jobs under the current conditions. So current conditions have to change.
We've also seen some consolidation and attempted consolidation, of course, within the railroad industry. Does that also contribute to potential safety issues, or do you think that, when you have integration, it can go smoothly and not risk
those
kinds of things?
I'm not sure what you mean by consolidation. I mean, you've got the major merger in play on the table right now, and my sense is that's likely to go through. And the expectation is that this is the last merger you're going to see for the foreseeable future. So I don't see so much consolidation, but I do see a matter of finding a different balance, and consolidation doesn't seem to me to be a huge threat in the sense that the industry has an incentive to be safe, and the mistakes are made. You have this event in East Palestine. It isn't really clear to me that a mistake was made. It looks like the employees on the train, and there were 3 operators on the train, they did the right thing. Maybe they didn't have the right information, and so that's a technological problem that we can solve. But I guess I don't see a long-term threat here. And one of the things you have to keep in mind is if you didn't have whatever it was, 330 or 350,000 gallons worth of hazardous materials on that train, how would they have moved? They would have moved in 30 trucks. Would they have been safer? And the evidence is no, they wouldn't have been safer.
And speaking of hazardous materials, do you see more regulations coming down the line when it comes to transporting hazardous materials via rail?
It's possible, but I seriously doubt it. I mean, again, my sense is let's try to understand what the causal factors here were and address those causal factors. So I would not jump right away to regulation. It doesn't say that it's going to happen, but I don't see that as an immediate answer. Probably if there's a change in operations and strategy and in regulations, it may be in detecting events as they proceed, that is to catch this before it happens. But I don't think it's a matter of pulling hazardous materials out of the railroads. One of the things to keep in mind is that railroads have an obligation to serve. They have a common carrier obligation, and within broad limits, they're not in a position to say, no, I won't carry your goods. Their business is to keep the economy going. So the question is, how do you find a way to assure that? They're motivated to do it. Norfolk Southern is going to pay a price for this, at least certainly a public relations price, if not a monetary price as well. the whole industry will learn from this. Going to more automated detection, yeah, probably a really good idea. Feasible, costs money, that's fine, it's worth it.
All right, we'll see what happens. Joseph Schofer, thank you so much for your time this morning. We appreciate it. Joseph is Northwestern University Professor Emeritus of Civil and Environmental Engineering. And let's talk your trending ticker there. Shares of MongoDB, they are trending and they're down sharply despite a beat on the top and bottom line. By the way, the stock was down much more earlier. The company did see near record direct sales, net adds, and profitability overshadowed by the infrastructure software company's outlook. It reported lower than expected revenue forecast for the first quarter and full year fiscal 2024. Most of the analyst commentary I have seen around MongoDB has been relatively positive, though, which I guess accounts for the stock now coming back from the lows. Coming up, WWE making a play to legalize betting on its own matches, which it knows what the outcome is going to be. How's that going to work? We're going to talk about it next. Let's do a quick check of the markets now, sponsored by Tasty Trade. We see all three major averages higher here. The Nasdaq, though, had been higher even more. Now it's up about 0.5%. But we are, of course, seeing a lot of investors wait until tomorrow's jobs report. Just looking at some of the movers in the S&P 500, it looks like SVB Financial, the parent of Silicon Valley Bank, which we talked about earlier, is down the most in the S&P 500 today, plunging more than 30% on plans for a share sale. WWE is hoping to cash in on the online gambling craze. The company reportedly in talks to legalize betting on high-profile scripted matches. Joining us now to dive in a bit deeper, we're joined by Josh Shaver. Everybody's talking about this story, Josh, because it is like you can bet on almost anything, right?
Right.
But you can't bet on almost anything with the organization that determines the outcome of the bet.
And you can't bet on scripted things is really normally the big
I mean, I guess you can bet on like the who's going to die in this TV series, right?
on usually like an offshore book, though, not
Exactly.
necessarily.
Exactly.
Yeah.
Right.
And
You're
so
not betting with Paramount on who's going to die on a Paramount
And so
show.
the WWE is kind of going through the front door here, like you said. So this is all a CNBC report. I reached out to WWE. They declined to comment. Multiple sports books I talked to earlier in the day said that this was news to them. Obviously, you would think that the sports books and the casinos would have to be looped in at some point if they were going to do this betting. And so what CNBC is reporting is that the WWE has reached out to state gambling regulators in Colorado and Michigan to bet on scripted matches. Now, as we just showed there with a map, sports gambling is widely legal basically in the United States at this point. In over 33 states. In DC, you can bet. You can bet on things like the Oscars this weekend in less than 10 states. So state regulators thus far have not been very comfortable with the concept of betting on something that is regulated, that is scripted. And then I should add, I spoke to some sports books this morning, and really it was surprising how they have not discussed it at all internally. They said they had no idea this was coming, and they pointed to basically the scrutiny that they see when they're even trying to get live sports gambling passed for certain sports. We've talked a lot about Live Golf on this program over the last 10 months. That's a new golf league that appeared. They said that they pretty much couldn't get approved because the Facebook feed, it was originally on Facebook Live, and it was a laggy Facebook Live feed. And state regulators were worried about that impacting the outcome from someone that was there, calling someone and betting on it. So this is a highly, highly regulated market, and sports gambling companies have not succeeded as far as getting things like that approved or not wanted to get into that market. And that's something that I think you have to think about here. There's someone that has to make a market and be comfortable offering those odds. Would you be comfortable offering odds on something when you know someone else might know the outcome? That's probably not the best business model, and these sports books and casinos probably wouldn't want to offer that.
I want to ask real quick, why I mean, obviously it wants the additional income stream, but WWE has also been undergoing some turmoil, safe to say, in terms of its leadership. So, what's the backdrop here as we're talking about this story?
Yeah, I mean, it seems like everyone wants to get into gambling that has some form of content right now, and we talk about it a lot, right? Gambling just sort of, it keeps people engaged throughout the entire stream of a broadcast, right? That's what a lot of people go for here, is if you can gamble on the first match in WWE and then there's multiple matches throughout the night, you can keep people engaged, keep them there longer. If people are watching the stream longer, you can make more money off advertisers. So there's a path to more money there. But again, it's a scripted show, and that's not really something we see a lot of. So I understand it. And when we talk about the WWE sale, right, Julie, if they had gambling, that would certainly be more advantageous because maybe they could make more money, but it seems like something that's a little far off right now.
Yeah.
It'll be interesting to watch. Josh Schaefer, thanks so much. And revenue from Eisai's Alzheimer's drug expected to top $7 billion by 2030 as competitor Eli Lilly suffers a setback to its efforts in treating Alzheimer's. Here with the details is Yahoo Finance's Anjali Kamlani. Anjali.
Yeah, so this has been an interesting space. We know, of course, the debate over those amyloid plaques. That's really been a target. Eisai, along with their partner Biogen, set to really hit the market soon, waiting for the FDA to get their final action by July 6th to open up what could be the largest payer, Medicare. Meanwhile, they're targeting all the other markets in the world, as you might imagine. And in a presentation to reporters today, did say that they expect the revenue to top $7.3 billion by 2030. I had to do some conversion there. The original was in yen, so that's where we're getting that number from. Meanwhile, we do know that Eli Lilly, also in the same market, we got the results for an older drug that they were looking at. They had already abandoned this drug in 2016. They started looking into it in 2013, and they found some benefits, but it didn't clear the plaques. They also did not manage to get the primary endpoint met, but they still agreed to do a clinical trial with the National Institute of Aging and get some results there for asymptomatic Alzheimer's individuals. So that's where the results we saw that caused, the reports of a setback there, but they've already really moved on. They're waiting for a phase 3 trial expected in June, the results in June, from a different drug that they're testing. So stay tuned. They are not out of the game just yet.
And let's also talk about like the overall landscape here and what it looks like for potential treatments for this, right? Because we have a lot of different players that are aiming at this.
They are. And so behind all of that is that conversation about amyloid plaques. For a long time, it has been a concern, a debate, whether or not that should be the target. We know with the newest drugs, specifically from Biogen, they have gotten somewhere in that debate in terms of that's where everyone is starting to look. That is the new target. And specifically how to go after that. So clearing plaques seems to be sort of the underpinning target right now for anyone in the game. And yes, to your point, lots of players behind this. We know we're waiting on other results as well, other drugs. So lots going on.
Lots going on. We'll count on you to keep track of it.
Absolutely.
Okay, thanks, Anjali. Appreciate it. Coming up, Grayscale has been lobbying for years to transform its trust into an ETF. This week, an important milestone in court. We'll hear from Grayscale's CEO on that topic next. Earlier this week, a panel of judges on the D.C. Circuit Court of Appeals heard arguments from Grayscale Investments and the Securities and Exchange Commission to determine whether the SEC's reasoning for rejecting Grayscale's application to convert its Bitcoin trust to an ETF was reasonable. I talked to Grayscale CEO Michael Sonnenschein following those closing arguments and started off by asking him how confident he is that the ruling will go his way.
We were certainly really appreciative of the opportunity to have this case heard by the D.C. Circuit Court of Appeals. Walking out of the courtroom, I would say we all felt very encouraged by how oral arguments transpired. And I think that's really a function of the legal team we have in place. We've put together the best-in-class legal team, and we've been consistent. The arguments that we've outlined why GBTC should be an ETF was the same when we filed our application, was the same when we had to litigate and file our briefs with the SEC, and they were the same earlier this week when we had oral arguments. And I think that consistency really works in our favor, and I think the market reaction is similar. Investors and folks are telling us anecdotally that they appreciated the oral arguments, and they're hopeful that the court will, side in our favor.
Yeah, GBTC rising in the wake of the hearing. You've talked about a timeline if you do get positive approval, which can take some months. Maybe even as soon as fall, we could see that ruling and a conversion. How quickly can a conversion happen if it goes in your favor?
Well, so what we've been guided by counsel is that we should expect a decision out of the DC Circuit by this fall. What transpires from there in terms of proactively working with the SEC on a conversion will obviously be something that we'll need to work out with them when that time comes.
One of the things that you were questioned about yesterday is the possibility, right now the SEC allows Bitcoin futures ETFs, but not a spot ETF. And the judges really talked about the sort of dichotomy or the questioning around that. On the flip side, the Securities and Exchange Commission, which has approved those products, in theory, could at some point rescind approvals, not just for the ETFs, but for Bitcoin futures, for whatever reason. What then would that do? What would be the cascading effect for you if that were the case?
I'm not aware of precedent where we've had, a year plus and billions of dollars of capital in investment products that are trading every single day and seen the SEC rescind those types of approvals, right? We don't have just one Bitcoin futures-based ETF here in the US. I think we have 3, maybe even 4 of them.
And some in Canada too, I believe.
Some in Canada, some in other jurisdictions as well. And so that, again, is really the bedrock of the case that we have. These are 2 markets that are inextricably linked. Bitcoin futures is a derivative of the Bitcoin spot market. So if the SEC got comfortable with Bitcoin futures as the underlying asset for a Bitcoin futures ETF, well, then they ultimately really also got themselves comfortable with the underlying spot market as well. And that's why GBTC should convert, as well as giving investors greater protections, right? That's the big takeaway from oral arguments and what we've been hearing from investors. This is the chance to take the world's largest Bitcoin fund, built in the U.S., raised in, under U.S. rules and regulations, and to bring it closer into the regulatory perimeter. That's an opportunity that, as a regulator who's meant to protect investors, should be seizing.
Why is it so important? Forget about the regulatory perspective for a moment. Why do you think it's so important for investors to have the trust be converted to an ETF?
Well, certainly today, the trust, trades at premiums and discounts. It doesn't have that embedded arbitrage mechanism. And so GBTC today, could be at a 40% discount to its actual net asset value, to the discount of the Bitcoin that it actually holds. And so in an ETF format, investors trading in GBTC, whether it's short-term, long-term, holding it for a very long time, investors will be in an instrument that effectively tracks the price of the underlying Bitcoin it holds. And we've seen now in the US, I think there's over 2,000 ETFs. This is a tried and true wrapper that will give greater protections, greater transparency, and all of that also comes with sitting on a national securities exchange, which in our case is the NYSE ARCA.
You could also argue an ETF is easier and more liquid to trade, right? Just sort of ETFs by definition is not a closed-end fund. And you can also redeem your funds. And this is something you've been hearing from investors as of late, some of whom want to more easily redeem their funds. There is a sort of a loophole, if you will, called Regulation M. You guys could, in theory, go under Regulation M and allow some of your investors to redeem those funds. Why not? Why not go that route? Why not even go that route simultaneously while you're still trying to get ETF approval?
Well, so Reg M is a separate and distinct set of rules than things like tender offer rules, right? So Reg M is something that is granted, or actually relief from Reg M is granted to ETF applicants. So the lawsuit itself is actually at its core asking for Reg M relief, the ability to simultaneously create and redeem shares of the fund, which will allow it to track the underlying value of the Bitcoin that it holds. Earlier in our life cycle, Grayscale did have a redemption program for GBTC way before it even went to the public markets as GBTC, and it was deemed to be in violation of Reg M. So since that time, we haven't operated a redemption program. We got a cease and desist from the SEC back then and haven't been able to operate a redemption program. So have
you tried to do it in other ways, in talks with the SEC? Or
Well,
did you just sort of say, okay, once you got the cease and desist, we're not going to try and do that again?
Well, under the cease and desist, we can't operate a redemption program. So what we've really been focusing on is offering public market liquidity for GBTC on the secondary market. It's become one of the most liquid securities on the OTC market here in the US, and was really a pioneering move on our part to be able to take a private fund and bring it out into the public market, which has really opened the opportunity of investing in Bitcoin to a very wide audience.
One of the specific examples of an investor who is asking for a redemption is FTX, or I should say now the administrator in bankruptcy of FTX, who wants to redeem some of the funds. Is there any way to do that under the existing framework?
So I think the complaint you're referring to is actually coming out of Alameda, right? So Alameda is the now defunct hedge fund arm of Sam Bankman-Fried's FTX empire. So if we look at Alameda, they're not a US-based business. They're not under US regulations. And that's really in sharp contrast to a business like Grayscale or Grayscale Products, built in the US under US rules and regs. Alameda now, obviously we all know, we've talked about this, a lot of fraud, a lot of things that transpired that have forced those companies into Chapter 11. And so under the new leadership at Alameda, from a fiduciary standpoint, they're wanting to try and recoup assets wherever they possibly can. And we don't fault them for doing so, but they're quite misguided with this complaint. It completely flies in the face of what we're doing with GBTC. Converting it to a Bitcoin ETF is the best long-term product structure, and also, more importantly, the product structure that's going to actually unlock the most value for investors, which includes Alameda.
But they're not long-term holders. The job of John J. Ray is to retrieve as many of the assets as possible, right? So you're referring to an investment case, which is not really necessarily relevant to what they're seeking, right?
Well, I think it's fair to say that the newly appointed management at Alameda is inheriting a series of investment decisions that were made prior to them. So actually being able to speak to the intent of their timeline or however it was that they made those investments would be really tough to do.
And that was Michael Sonnenschein of Grayscale Investments. Let's get to a quick mover here that's quickly moving up the trending ticker charts, and that is General Electric, the company holding an investor day today and coming out with some long-term targets as a result of that, among other things, talking about its long-term expansion plans. GE Aerospace, it is predicting revenue growth in the mid to high single-digit rate, and it says it's going to generate free cash flow in line with net income. And again, that is over the long term there. In terms of its power equipment and renewable energy units, it says those will grow at a mid-single-digit rate with high single-digit profit margins. So that's some of the commentary that's coming out here. Larry Culp, the CEO, saying we're operating from a stronger foundation and as a fundamentally simpler business that's creating significant value today and going forward. And of course, the simpler business that he's referring to is the big sort of splitting up of the company that is ongoing, right? It has not yet been completed. So we'll continue to watch some of the headlines coming out from this. But again, those shares going higher. Coming up, we talked earlier with CrowdStrike CEO George Kurtz about the cybersecurity landscape. Next up, we get the view from another angle of the cyber stack with Zscaler CEO Jay Chaudhry. We have been talking about the outlook for cybersecurity and what the demand is from large tech firms and small tech firms for that matter for those kinds of services. Zscaler reported its numbers last week, and some of the billings numbers did disappoint analysts and those on the street. But let's dig more into what's going on in that business. We're joined now by Jay Chaudhry, Zscaler CEO. Jay, thank you for being here. And I have to start by saying I embarrassed myself a little bit last week. When we talk about cybersecurity and enterprise software writ large, I have to admit, sometimes I have trouble with the nuance of what each company does and kind of where they fit into the stack. So let's start there, if we can. Talk to me about Zscaler and where you guys fit into the picture.
So we are like an international airport. When people are coming to the country, leaving the country, we are making sure that right person can go to the right plane to the right country with the right luggage. So we're inspecting to make sure the visa is given, passport is right to keep people safe. All bad things come from the internet. All good things leave to the internet. So we are the checkpost to make sure right party talks to right party for cyber point of view. Now, if you contrast that from endpoint security says, let's make sure my laptop doesn't get infected. It's like having a door and lock on the house so people don't wander in. We complement endpoint security by doing security in the cloud. So if we know that a bad guy is trying to get close to your house, we stop them at the airport. They can't even come close. Does that help?
Yes, it does help, Jay. Thank you very much for that explanation. So as we talk about that stack then, as I mentioned, you guys came out with earnings. The earnings looked strong. They beat estimates. There was a little bit of commentary around billings and the macro environment. So if we are seeing tech companies make their budgets right now, are there parts of cybersecurity where you're concerned that we're going to see some cutbacks?
There are cutbacks on broad IT budgets at the CIO level. Generally, the cyber budget is either flat or slightly up. So there is some pressure and scrutiny, but overall, cyber is much stronger. Zscaler delivered good results. Our revenue went up 52% year over year. Our billings were up 34% or so. Our cash flow, 16% of the revenue. So these are good numbers. You know, markets do what they do. Sometimes it's a matter of expectations being set. I have one focus: build innovative, great solutions for our customers and make sure we support our customers, we keep them safe, we keep our country safe. I just came from a large public sector security summit that Zscaler did yesterday in Washington, D.C. We had some of the big cabinet agencies representing us. Melinda Rogers, the CIO of DOJ, was one of the key speakers. So we are protecting our country. We are protecting some of the largest companies out there, which includes 40% of the Fortune 500 companies.
Jay, Ines here. Given that macro backdrop that you just talked about, which pockets of the market do you see the next opportunity in?
So if you think about some of the verticals, we're seeing some tightness on technology sector, we're seeing some tightness on consumer sector, but most of the other companies, financial companies, manufacturing companies, they got strong interest. The larger companies have to worry more about their cyber because they're generally targets. So we work with them. So we see pretty good strength in large enterprises. There was a time when Europe was a little weaker. Europe has become pretty strong. So we see business strength overall pretty good across the board. That's why Zscaler actually raised its forecast slightly, while many of the companies are reducing their forecast.
And Jay, we've been talking all day long, really all week long, all year long, about rising rates, which of course has had an effect on corporate budgets. That's one of the things that's been pressuring them. How do you think about rates for your business and your clients' business, and how much of a headwind is that going to be?
So rising rate is putting pressure on IT budget. That's why CIOs is being asked to reduce their IT budget. So CIOs I talk to lots and lots of them. They're looking for two things from companies like Zscaler. Number one, they need to protect their enterprises. So cyber is important for them. Number two, because of budgetary pressure, they are looking for cost reduction savings. And Zscaler is one of the few cyber companies that's eliminating a lot of point products and actually saving money. So our dialogue with CIO starts with, I can give you cyber and I can give you cost savings. And that's how our business is growing. That's how there's a lot of interest in working with companies like Zscaler. Otherwise, many cyber companies are essentially cost. That's what sets us apart.
Jay, Dan Ives of Wedbush had made some comments after you reported your results, and he talked about federal cybersecurity spending, which looks good. Is that an area where you see growth?
Federal government has done a great job. Biden administration over the past 2 years has pushed for better investments in zero trust architecture, which is the better way to protect rather than traditional firewall VPN-based architecture. We have strong federal presence. We have invested in federal over the past several years by getting some of the biggest certifications. If you don't have FedRAMP certifications, you can't play. We have the highest level certification. There are about 700 plus public sector entities and organizations who are Zscaler customers. So we had good federal business in Q1. Q2 was somewhat light, and we expect the second half to be quite strong.
Zscaler CEO Jay Chaudhry, thank you so much for joining us. And coming up,
thank you for the opportunity.
Thank you. The big business of toys. Brian Sozzi will sit down with the CEO of Mattel next. Join us.
wheels are turning at toy maker Mattel. Shares are in focus following the company's Investor Day, where executives laid out the company's growth plans as it continues its push more into film and television. Joining us now is Mattel CEO Ynon Kreiz in a Yahoo Finance exclusive. Ynon, always great to get some time with you. Look, big presentation and focus on the ongoing reimagination of that Barbie brand. Take us inside the efforts to rebuild that brand and things you are focused on this year.
Hi, Brian. Great to see you again. Barbie is such an incredible brand. We saw the brand continue to evolve. We are launching the movie this year on July 21st. It's going to be a great event. We believe it has all that it takes to make it a societal event, a cultural event, and it is part of our transformation to continue to grow our IP-driven toy business and expand our entertainment offering. The Barbie movie has some incredible innovation. It's directed by Greta Gerwig, but an incredible cast led by Margot Robbie and Ryan Gosling and Will Ferrell, as well as some incredible actors that will support it. And we expect Barbie to continue to grow. We just launched yesterday another collection of STEM career Barbies led by the Wojcicki sisters. And we couldn't be more excited about Barbie's long-term growth prospects.
Look, Ynon, I'm 40 years old. I don't know much about dolls, but they look to me like what they're changing. They reflect more of the society at large. Has that been a focus of you? I know what the dolls you just mentioned, to me, those are fearless women in business. Is that right?
Exactly. Our brands are all led by a very clear purpose and cultural relevance. Barbie reflects the world as children see it. Barbie's purpose is to inspire the limitless potential in every girl. And the journey has been very distinct. More than half of the Barbies we sell are diverse, not the original white skin and blonde hair Barbie that we used to know. So Barbie very much is about diversity, inclusivity, and empowering girls to reach their limitless potential.
At the Investor Day night, there was a lot of talk about this year being the year of dolls. And I'm holding up two here, one from Anna from Frozen and one from Snow White from Disney Princess. And this is all part of your efforts to just build out the portfolio of dolls. How much do these brands or brands like this, how much will they bring in sales this year?
Well, we are expanding our dolls portfolio, and Disney Princess and Frozen is a very important part of that strategy. We have some incredible product of Disney Princess and Frozen, and it will continue to be a key focus for our company. It is one of our core strengths. Dolls, vehicles, and infant, toddler, and preschool are the three categories where we are a global leader. And we continue to expand and innovate our product offering. This will be yet another demonstration of our innovation and capabilities when it comes to the dolls category, and it will be an important year for us in this area.
We've closely been following on your efforts to focus more on content. Can you give us an update on that this year?
Sure. We own one of the strongest portfolios of children and family entertainment franchises in the world. And that gives us significant opportunities to expand and grow our business and have multiple touch points with consumers. And content is an important part of it. We talked a little bit about our movie strategy. Barbie is our first movie. There are 14 other pictures that we are now developing that we already announced. And on the television side, we also see incredible progress with a lot of innovation. We are launching 12 series and specials in 2023. It will have some really exciting offering. We just announced recently the new Hot Wheels show that will launch on NBC later this year. It's a show that will be about a car makeover competition, and it's called Hot Wheels Ultimate Challenge, and it will be another representation of more innovation for Mattel. There will be additional content of Barbie on Netflix. And of course, we also announced recently the launch of Barney that will relaunch in 2024, but it will be supported and accompanied by great content, both on television and film that we're now developing for future fans.
And we'll take this offline, but Barney was a hot topic for me back in school. Well, but we're not gonna. We'll leave it there. I don't want to get too much into my childhood. But you are fresh off of earnings, of course, too. How much of the inventory overhang in retail, from a toy perspective, is left out there, and when does that get cleared?
Yeah, we did talk about elevated inventory that we have entering 2023. It will impact us primarily in the first half, but we expect that to clear over the year, and we do look to see positive increase in consumer demand for 2023. We are working through elevated inventory, but even with the continued macro uncertainty, we are confident about our strategy and plans for the year. There will be several exciting launches and initiatives that we'll bring to the market. We talked about Disney Princess and Frozen for the year. We are also very excited about the global rollout of Monster High, and of course, the Barbie movie in July, which will stimulate more demand. We continue to execute our multi-year strategy. We have a very balanced portfolio. Our category structure is working very well. We're seeing product in demand, although it's still early to tell. We're off to a good start in the year. And there's a lot of cross-category innovation in all of our portfolio. Beyond 23, we believe our strategy will continue to drive top and bottom line growth, and we aim to outpace the toy industry and gain market share.
Well, this has been a strange weekend in markets. Now there's concerns about rates going even higher. That has impacted the stock market. Consumers are starting to get jittery. How concerned are you about where the economy is at this point?
Well, we continue to monitor the economy. We do expect to see impact on consumer demand, although we still do believe the industry will be flat to slightly up. The toy industry has demonstrated its resilience over time, and we expect it will continue to grow over time. Within that, we do expect to grow market share. But it is important to say that we are entering this year with the strongest balance sheet we've had in many, many years. Even in a challenging market and volatile market in 2022, we continue to improve our leverage ratio and strengthen our financial position. And that gives us flexibility and optionality to continue to improve our position and strengthen our competitive standing. We have begun share repurchases for the year after 9 years. And this really tells you how confident we are in our financial strength and opportunities that we see for Mattel to continue to grow and create long-term shareholder value.
Well, who's confident on that He-Man? I believe that's He-Man behind you. That is, as a toy geek, of course I'm going to recognize this thing. Always great to get some time with you. Mattel CEO Ynon Kreiz. We'll talk to you soon.
Thank you so much, Brian.
All right, appreciate it. And we'll be right back.
Well, President Biden is expected to outline his annual budget, laying out what's happening for spending and revenue priorities. Be sure to stick around for the next hour. We'll get into the details of what that may entail with Deputy Director of the National Economic Council, Bharat Ramamurthy.
And we'll also take a look at safety in the U.S. railroad industry with Jeremy Ferguson, Smart Transportation Division President, as Norfolk Southern faces the Senate over its train derailment incidents.
And our coverage does not stop there of the hearings. We're going to have more on Norfolk Southern Senate hearing later today in our 3 to 5 p.m. show with more guests. Be sure to tune in then. Obviously, an important hearing. We'll find out what's going to happen with the railroad industry. We've got all that and more. Rochelle Acuvo has you for the next hour of trading. Keep it right here.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast and 8 a.m. on the West. I'm Rochelle Acuvo. Here's a look at what I'm watching this morning. Stocks pushed into the green after a surprise jump in jobless claims. This as investors brace for Friday's non-farm payrolls report. All this as the size of this month's rate rise is still unclear. And Norfolk Southern in the spotlight on Capitol Hill. The company's CEO testifying in front of the Senate today following last month's train derailment in Ohio. We'll bring you the latest on that. And of course, President Biden unveiling parts of his 2024 budget today in Philadelphia, the first in front of a divided Congress. Full details will come out at noon, and we're all across it. Well, let's start with how the major indices are faring. As we mentioned, they're in the green for all three so far. We have seen quite a bit of oscillation, though, this morning as we await more details from Powell as he continues to testify. We're seeing the Dow here just up about 0.25%. Same situation for the S&P as well. We're seeing, though, the Dow did get a boost from Intel, which is up more than 3% today. Nasdaq also in the green today, the strongest performer, up about 1/3%. Also taking a look at treasuries as we see more people pouring into stocks, pulling away a little bit from some of these shorter term yields. We're seeing the 10-year began the day above 4%, but has since slid below that mark. Also seeing the 5-year pulling back the most, though, about 1.25%. Well, now to our two top stories this morning. President Biden takes the wraps off his budget proposal. The deal expected to face opposition from a divided Congress, though. We get a fresh take on this from the White House with Bharat Ramamurthy, Deputy Director of the National Economic Council. And meanwhile, we're also hearing more out of the Norfolk Southern hearing, the CEO giving his opening statement with an apologetic tone and saying safety measures were not good enough. Now, the CEO also said Norfolk Southern would stay in the town of East Palestine, Ohio, for as long as necessary. The investigation into the train derailment there, into another more recent one in Ohio, still continues. Well, President Biden out with details on his 2024 budget proposal with Republican control of the House, all but ensuring that the proposal will not become law. For details on the proposal, Yahoo Finance's Jennifer Schonberger has the latest. Hey, Jennifer.
Good morning, Rochelle. That's right. President Biden formally rolling out his 2024 budget proposal today. The president expected to lay out his vision, including shoring up Medicare to cutting wasteful spending to trillions in new spending. It will reduce the deficit by nearly $3 trillion over the next decade through a series of tax increases on corporations and wealthy Americans. The president expected to reprise a number of tax hiking proposals, including a renewed call to quadruple the 1% tax on stock buybacks implemented January 1st to 4%. Also expected, raising the corporate tax rate to 28% from currently 21%. Also closing tax loopholes, including the like-kind loophole real estate transactions in which owners can defer capital gains from one property transaction by investing in another, as well scrapping tax breaks that oil and gas companies receive. Now, President Biden will also reportedly propose changing the tax treatment of cryptocurrency transactions, which would raise $24 billion. Those sales aren't subject to the same so-called wash sale rules right now that apply to stocks and bonds. That means people can sell their underwater crypto investments, take that tax-deductible loss, and then buy right back into the same investment. Now, the president is also floating 3 proposals to extend the solvency of Medicare by at least 25 years through increasing tax rates on those earning more than $400,000 a year, closing loopholes that shield some so-called pass-through income from Medicare taxes, and allowing Medicare to negotiate on a wider array of prescription drugs. Elsewhere, Biden is reportedly expected to put forth a defense budget of more than $800 billion. That's higher than last year's request, though comes against the backdrop of continuing conflict in Ukraine and rising tensions in China. Now, Rochelle, with trillions in proposed spending, Biden's budget expected to be dead on arrival with Republicans in Congress, though it will serve as a kickoff point for spending negotiations as that debt ceiling limit looms. The president expected to make remarks on this at 2:30 this afternoon in Philadelphia, that budget formally rolling out at 12 noon today. Back to you.
All right. Thank you for that wrap. Yahoo Finance's own Jennifer Schonberger there. Thanks so much. Well, let's get the view from the White House now. Joining us now is Bharat Ramamurthy, Deputy Director of the National Economic Council. We do appreciate you joining me this morning. So, as we mentioned, there are a number of themes that the president plans on covering in this budget, though. Would you agree, though, is this dead on arrival, being that Republicans really don't have any sort of support for these proposals?
Well, as you've laid out right there, the president's about to propose a budget that does a few things. Number one, it protects and strengthens Medicare and Social Security. Number two, it keeps investing in the types of programs that middle-class families, lower-income families need and that help the country grow. And number three, it reduces the deficit over the next 10 years by nearly $3 trillion. So it's a prescription for continuing the momentum that we have in the economy and putting us on a better fiscal path. As for whether it's dead on arrival, I urge you to ask that question to House Republicans that you may have on this program. I would be curious to know from them what it is about asking the very wealthiest folks to pay a little bit more into Medicare to strengthen that program for the next 25 years. What is it about that they oppose? What do they oppose about cutting Medicare spending on prescription drugs, which saves taxpayers money and saves seniors money. What is it about that they oppose? Why are they so interested in protecting extra payments to the big pharma industry? So it's a good question for you to ask them.
So then in terms of some of the funding here, then how far would that actually go to shoring up Medicare and Social Security, especially when you consider this massive baby boom generation that's retiring?
Yeah, what our projections show is that with a few changes to the Medicare program, number one, allowing the Medicare program, building on the progress that we made last year, allowing them to negotiate the price of more drugs, saves taxpayers hundreds of billions of dollars over the next 10 years. Number two, closing some loopholes that exempt certain high-income net investment income from from going into the Medicare trust fund. By closing that loophole, those two changes combined increase the solvency of the Medicare program by 25 years. So that accounts for demographic changes, the baby boom generation, and so on. So the president has made clear that with these two small changes, we can extend the solvency of Medicare by 25 years. It's worth doing from his perspective. And again, I would pose the question to Republicans. If you are in favor of extending the solvency of Medicare and protecting Medicare benefits, why do you oppose these two changes?
And I mean, that's a fair point. We are still waiting for details of their proposed budgets as well. But I do want to ask you something that's also come to the forefront. We know that President Biden hasn't really hidden his disdain for some of these Trump-era corporate tax cuts that have then gone on to be used for stock buyback programs. How does the president plan on navigating that, you think, while also trying to encourage more companies to invest and grow in the U.S.?
Well, it's a good question. I think, number one, what we've already seen is because of the investments that the president has secured through Congress, the infrastructure bill, the Bipartisan CHIPS Act that passed last year, and the Inflation Reduction Act that passed last year, we are seeing an incredible amount of investment in the United States. $300 billion worth of direct private investment and more production in the United States, across the Midwest, across the South, the Southwest. New factories are coming up because under President Biden, America is a great place to invest. At the same time, he's made clear that when companies come to the United States, they should be creating good paying jobs. And when they make earnings, sure, some of that can go back to shareholders in the form of dividends or buybacks, but it should be taxed. And at the margin, we should make sure that these companies are reinvesting earnings in more production, in better quality jobs in the United States. That's the balance that we're trying to strike with this budget.
So then as we go from Wall Street to Main Street, then obviously a lot of different things that the president could cover today regarding lowering costs for everyday Americans. You mentioned big pharma and prescriptions there, but also things like education, paid leave as well. How much focus in terms of what the president might prioritize in his speech can we expect to hear?
Well, the president has made clear for the last year plus that lowering costs for American families and tackling inflation is his top economic priority. And what you're going to see in the budget is a series of proposals that would do that in a number of areas. Number one, prescription drugs. We've already cut the cost of prescription drugs for seniors on Medicare substantially this year, whether it's insulin or other prescription drugs. Number two, childcare and massive cost for families with young children. The president has put forward a proposal that would make childcare affordable for families with young kids. Number three, we're going to keep making progress on the energy front, building on the progress we made last year. The historic increase in oil and gas production in the United States, coupled with releases from the Strategic Petroleum Reserve, have helped drive down gas prices at the pump. We're committed to continue to make progress on that front as well.
And I did want to ask you about something that's also been coming up. These so-called junk fees, some of these hidden and sometimes illegal fees that get tacked on to all sorts of things in terms of mortgage loans, student loans, auto loans. Do we expect much focus on that? And how costly is that for the American consumer?
Well, certain studies have found that it can cost hundreds of dollars a month to your typical family between the cost of travel, hotels, airline tickets, fees for rental payments, and so on. We are committed to going after these junk fees, in some cases just making sure that they are fully disclosed up front so that when people are comparison shopping, they can make the best choices for them. In other cases, we want to go ahead and eliminate those fees. So for example, at the State of the Union address a couple of weeks ago, the president called out family seating fees, the fees that airlines charge parents just to guarantee that they're going to be sitting next to their 10-year-old child on an airplane. Since he made that call, already we've seen American Airlines, Frontier Airlines eliminate those fees voluntarily.
And so it's just one other tool that we have in our toolkit here, the bully pulpit, pushing corporations to eliminate these junk fees. And at the same time, we're going to be working with Congress to address them as well.
And we're also going to be seeing defense spending prioritized as well. How much pushback, though, are you expecting on that?
Well, look, we're going to lay out our case for why we think the level of defense spending we're calling for is reasonable. As you noted at the top of this segment, we have the ongoing Russian war of aggression in the Ukraine, and that's creating additional needs for the U.S. military budget. At the same time, we are calling for a more modest increase in defense spending than we are in other categories of spending, which I think reflects our view about the relative prioritization compared to where we are today. So we look forward to having a healthy debate and discussion about not only the defense spending portion of this, but each element of this. And as we've been saying for the last several weeks, as of noon today, we will be laying out in vivid detail, line by line, the spending we are in favor of and the tax revenue we are in favor of. What we are still waiting for from the Republicans is anything remotely similar, anything that approaches some kind of coherent plan for how they propose to continue to invest in America while addressing the deficit. We're waiting eagerly for that document.
And one thing I do want to ask you about is obviously the debt ceiling standoff, of this budget coming out with that in the background. Now, neither side appears to be budging at all. And the Washington Post reporting on a GOP measure dubs the Default Prevention Act as an alternative route, perhaps prioritizing certain payments over others. What's your take on that? And what is the likelihood of a U.S. debt default at this point?
Well, look, that's a good question to ask the House Republicans. We've raised the debt ceiling nearly 80 times in the history of this country. We've never defaulted. And yet House Republicans are threatening a first ever default, which would throw the global economy into chaos. And now they have this new bill, which says that if they cause a debt default, they're going to make sure, and this is literally what the bill says, they're going to make sure that the Chinese government gets paid first before members of the military, before your family's nursing homes, before Medicaid recipients in your state. It reflects their priorities, apparently, for how payments should be made in the case of a Republican caused default. So Secretary Yellen said it best. She said that prioritization is default by another name. What we need to do, as we've done many times in the past, as was done 3 times under President Trump, is raise the debt limit without any conditions. And then if you want to have a separate conversation about spending, the budget, we've laid out our plans. We invite Republicans to lay out their plans, and then we can have a conversation about that once the threat of default is off the table.
We certainly look forward to hearing that discussion and, of course, hearing from the president later on this afternoon. Bharat Ramamurthy, thank you so much. Deputy Director of the National Economic Council, thank you for your time this morning.
Thank you.
All right, coming up, Wall Street remains hot on Apple this week. Find out what has analysts so excited. And the Walgreens abortion pill drama intensifies. See what action some states are taking when we come back. Welcome back to Yahoo Finance Live. Apple getting a vote of confidence from a pair of analysts this week. Goldman Sachs initiating a buy rating on the tech giant and setting a 12-month price target of $199. Meanwhile, Wedbush Securities' Dan Ives upping his 12-month price target from $180 to $190 while maintaining a buy rating. Now, this has helped spark a Wall Street rally for Apple, with shares up noticeably this week. As you can see, they're up more than 5%. Yahoo Finance tech editor Dan Howley joins us now. So Dan, why are these firms so optimistic about Apple?
Yeah, Rochelle, it's really interesting. You know, the Goldman note obviously coming out, putting a buy rating on Apple and that 199 price target. This is the first time in years that Goldman has done that. So they're initiating their coverage again. And then the Wedbush rating here with the $190 price target up from $180. And the big to-do seemingly has to do with services. Over at Goldman, the thesis really is that Apple has the chance to turn services into a much larger business. They have that kind of flywheel effect. I know that's kind of a thing that everybody talks about, but that they're able to draw in consumers. They're still getting switchers, surprisingly. That's something that the Goldman note also points out, that they're getting people from Android over to iOS in advanced markets or more saturated markets, while still looking for the opportunity to grow in more emerging markets, at least in the smartphone space, especially when it comes to places like India and the like. And that really is the next big market. But as far as services go, they do see Apple's ability to keep people coming back, to get them to push more into more services, Apple TV Plus, Apple Fitness Plus, Apple Music Plus, iCloud Plus, things along those lines. And that's really going to help generate continued growth going forward. And then on the Wedbush side of things, it's that, as well as Apple's ability to build out the iPhone kind of growth strategy, despite the fact that they had that slowdown in Q1. The lockdowns are over in China, so they're able to get more devices out the door. And so we're looking at potentially the iPhone 15. It's an anniversary edition, really. And so that could be a big device for the company itself. And then, oh yeah, there's that headset that everybody's talking about that is expected to come at some point this spring during its Worldwide Developers Conference. We'll have to see what the result is from that. But it does look like, you know, a lot of kind of bright, sunny outlook for Apple, at least from these two analysts.
And Dan, you mentioned India there. Apple shaking up its international operation and putting a bigger focus on India. Tell us more about that.
Yeah, they really want to start to build out more of their devices in those regions and also open up their own stores there. That's something that's been rumored for a while. They're going to be opening one of their physical locations. Right now, there are third-party resellers that sell iPhones. The deal was Apple needed to build more devices in India in order to open up its own stores. And so that's what it's doing. They are also moving the manufacturing to India just because they want to avoid the issues that they ran into during COVID with China. It's a mixture of that and then the geopolitical tensions between China and the U.S. Apple just doesn't want to be caught up in that. China is where the vast majority of their devices are built. And if there's any kind of, back and forth or retaliation, Apple's a huge company. It could be, front and center. So they're trying to move more manufacturing overseas from China, whether that's India, whether that's Vietnam. And so they're doing that at this point. And we'll have to see how long that takes. But it could be some time before they manage to get even a 50-50 split between China and other countries.
And Dan, we know a lot of companies really jumping in on generative AI, but we've also seen some news just crossing. Is the U.S. Chamber of Commerce looking to crack down on AI?
Yeah, they want to see some kind of legislation to come along to kind of handle ChatGPT, generative AI, basically to regulate it and ensure that it doesn't damage other businesses and that it's safe to use. And this is something that, usually government entities or, entities like chambers of commerce, business groups, tend to not want regulations, but we're seeing that here just because it's such a new and I think powerful technology. Look, there's a difference between deepfakes, which obviously we've talked about being dangerous as far as political issues go, but with ChatGPT, this generative AI, It's a larger issue when it comes to businesses as well. That's because you can take someone else's content and kind of reconfigure it and then put it out as your own via ChatGPT. So, there's also the inaccuracy problems, things along those lines. And I think that's why we're starting to see this kind of reaction. Although that doesn't mean that businesses aren't already moving to put it into action on their own platforms. And look, we're going to continue to see that moving forward as the AI space continues to really heat up. This is, by the way, just one piece of AI. There's still numerous other versions of AI that are out there. So you can imagine if this one slice is getting this much attention, imagine when we start to see the other ones really mature, how that's going to explode.
Definitely, and seeing regulators trying to at least try and get out ahead of it as they see how much momentum we've seen ChatGPT and other generative AI technologies come to the forefront. A big thank you there to our very own Dan Howley. Well, California is taking a hard stance against Walgreens. Governor Gavin Newsom announcing that the state will not renew its $54 million contract with the pharmacy store chain. That's after the company decided not to dispense an abortion drug in states where Republican officials are threatening legal action. Yahoo Finance senior reporter Anjali Kemlani joins us with more on this story. So, Anjali, why is California taking this stance?
Well, Rochelle, California took this stance, and what it does is actually end a contract that was set to expire on May 1st, in which Walgreens dispenses prescriptions to inmates in California. And so that's what Governor Newsom has ended. He has also threatened to find other areas where the company and the state interact and see what can be done there. Now, what's at stake here is really the future of the abortion pill dispensing across the country, especially after the FDA opened up the ability for mail order back in January. And so what's happening right now is a direct result of that. The governor taking the stance after 21 attorneys general sent letters to Walgreens asking them or threatening them with legal action if they dispensed in the state, citing different legal reasons, and Walgreens saying, well, we agree we're not going to dispense in these states right now. So that's sort of, the basic play-by-play right now of what has happened and what has led to this specific response from California.
I mean, sometimes we do see states on the opposing side of what some corporations want to do, but why has the situation escalated to this level?
Well, what's happening is actually very complicated and nuanced, very legal and also political. So what these AGs did was cite old, laws like mail laws, federal laws that have to do with the use of mail, and specifically for the use of anything related to abortion. They said in their letter that they, quote, reject the Biden administration's bizarre interpretation of then allowing the FDA to open things up, which was a result of the FDA relaxing the rules during the pandemic. That's where this first all started. They've also cited state laws prohibiting, and what has been true is that of the 20 or so states, abortion is legal in a handful of them, and there are specific laws that are kind of nuanced when it comes to whether or not the pill is legal but can be used through mail order, can be delivered through mail order, because many of these states tend to have pretty restrictive rules, including having to have an ultrasound, for example, before a patient is allowed to use the pill, or having to have some sort of consultation or a physician nearby when using the pill. So it does kind of shift the landscape, if you will, when it comes to what actually can be done, whether or not these pharmacies can play in these markets. Florida, for example, already does not allow pharmacies to dispense the pill. There are other states among those that signed on where abortion is legal. Iowa, for example, where yes, it's available now. Legislation has already been introduced to ban the pill, but that's on hold as the governor wants to ban abortion past 6 weeks. That's the stance that Texas initially held before it fully banned abortion. And 6 weeks is said to be a pretty restrictive timeline, not allowing for really a lot of room for any action to be taken. So you're seeing it all together there. Now, Walgreens' response, we know the part where they agreed not to dispense has been widely reported, but what hasn't been focused on is the sentence following, and it's kind of important because it gives them sort of a CYA where they say if the situation changes, they will notify these AGs. So they really left it open and on the table for a shift in policy, if you will. And if you can see on your screen, this is part of their letter in response. So All told, it's very complicated, very nuanced, and like I've said before, very much a developing story as we wait for the FDA to decide to certify and how it's going to certify mail order for these pills.
Indeed, very interesting take on some of the language there. As you mentioned, they're leaving the door open, so we'll definitely be keeping an eye on this story. Thank you for that breakdown. Angelique Kemlani there for us. All right, checking in on the markets here, sponsored by Tasty Trade. We see all three indices still in positive territory. The Dow there being pushed up by Apple and Microsoft, though we're seeing JP Morgan, though, down about 3% on the day, so keeping an eye on that. But for now, the Dow up about 46 points. The S&P 500 there also in positive territory, just barely, with tech leading the way there as a sector, being dragged down by financials, though. And the Nasdaq, of course, seeing the best gains there, driven up by tech as well, up 32 points on the day, or about 1/3%. All right, coming up, the president of North America's biggest railroad operating union tells us what changes need to be made after the recent Norfolk Southern trail derailments. Stay tuned.
We will be in the community for as long as it takes. To be clear, there are no strings attached to our assistance. If residents have a concern, we want them to come talk to us. Our website, nsmakingitright.com, provides the latest information and details on how to reach us. We have been cooperating fully with the NTSB's investigation into the cause of the derailment. The preliminary report found that the Norfolk Southern crew was operating the train below the speed limit and in an approved manner. Yet it is clear the safety mechanisms in place were not enough.
That's Norfolk Southern CEO Alan Shaw testifying in front of Congress in the aftermath of the train derailment in East Palestine, Ohio. We're looking ahead, what needs to change to keep the rail industry safe? Well, joining us now is Jeremy Ferguson, president of Smart Transportation Division, the largest railroad operating union in North America. Thank you so much for joining me today. Now, obviously, we see Norfolk Southern in the spotlight today, but how surprised are you that they ended up in this position?
Well, good morning, and thank you for having me. Honestly, we are not surprised at all that they are in the spotlight. Actually, we're surprised that there's not the spotlight. Obviously, it was the East Palestine, Ohio derailment that brought this to light when there was a mushroom cloud on everybody's TV. But for approximately 4 years now, we as the operating union have been trying to tell Congress and any other government agency that would listen how important it is to make drastic changes to safety procedures, regulations, and even laws. It's gone on too long now with this business model that the railroads have used in the United States called scheduled railroading. In the short term, it makes the bottom line look good, but in the long term, it's rolling the dice on safety.
So I want to dig deep. I want to dig deep on this. I want to dig deeper on this precision scheduled railroading and the role that plays in safety issues. Dig into that for people who aren't familiar with this and the impact that it has on the decisions they make on safety. Tell us more about that.
Well, the impact on safety is that they have cut back on the workforce across all crafts. When it comes to car inspections, when it comes to the amount of crews available to operate the trains, people are running short on rest, less time off. We've had a variety of issues, you name it, because you're trying to do more with much less.
And I do want to ask you, in terms of the political finger pointing, we know that a lot of people were saying, look, if the Obama era safety measures had not been reversed, we wouldn't be in this position. How much of that is true, though, considering what led to the derailment in East Palestine?
Well, it all plays a factor, but it goes back further than the Obama administration. The railroads and the American Association of Railroads, AAR, have done a very good job at being active in Washington, D.C. and lobbying against, proactive safty efforts just because it affects the bottom line. Now, it's difficult to get things moved through Congress, but we are very satisfied right now that, we are seeing some bipartisan support in the Senate with the Safety Rail Act of 2023. There's some positive changes there. Hopefully, as it progresses, there'll be even more safety factors included in that bill.
Well, we do appreciate you joining and taking your time this morning, Jeremy Ferguson. Thank you so much for your insights. All right, coming up, we take a closer look at the chip sector as the U.S. looks to hold its technological edge. Stick around.
we have to make sure that none of the United States' most cutting edge technology gets into the hands of the Chinese military. We're very clear-eyed about the fact that in certain areas of technology, the United States is ahead. We're ahead of China. We want to stay ahead of China. We know they're trying to get our technology to advance their military capability. And every time we get information about that happening, we will take action with our export controls.
Well, the US is looking to maintain its advantage in the tech sector by restricting exports to China. Other countries are doing the same, with the Dutch government now drafting new rules on chip exports. So how investable is the sector right now, given that a majority of the supply chain is reliant on Asia? Well, Citi warns the industry could see new lows. Yahoo Finance's Ines Ferre has the details. Hey, Ines.
Hey, Rochelle, yeah, and you were just mentioning the Netherlands joining the U.S. with restricting exporting of machinery to make chips gear to China. And ASML, that's the big company that makes the machinery to make semiconductors, that is based in the Netherlands. So certainly an important development there. But look, what we have seen is the U.S. Basically trying to make more manufacturing or to bring manufacturing of semiconductors here to the U.S. Normally, it's been that the U.S. designs the chips and then they are made abroad. But a lot of this has to do with what you were just listening to. It's protecting data, making sure that the semiconductors which process so much data these are very important to have within each country. So both the U.S. is putting money into semiconductors. China is as well. And you have Mobius Capital, which recently had been speaking to Bloomberg, talking about how this is very bullish for the chip industry, for both the U.S. and for China, which are both investing into this technology, into making the chips within its own borders. And manufacturing also is more manufacturing is going into India. The U.S. is making alliances with India to manufacture some of these chips. So if we just take a look at the semiconductor chart right now, today's action, you're seeing a little bit of green here, but you are looking at some of these that are a little flat, in the NVIDIA flat. But take a look at the year-to-date chart. Take a look at the rally that has happened year-to-date. NVIDIA up 65%, TSM up 20%. Now, some of this also has to do with that AI craze that we've been seeing, but a lot of this also has to do with the U.S. investments in manufacturing, bringing that manufacturing here in the U.S., going into India, not relying so much on China. Rochelle.
All right, thank you, Ines, for that update. All right, now time for what we're watching, our chart of the day. Now, that dusty old Rolex in your father's drawer might have a hidden complication beyond telling the time in Mumbai. Prices for second-hand luxury timepieces are outperforming even key market benchmarks like the S&P 500. This according to a study from BCG. Now, Rolex is, of course, just one of several watch hype brands seeing rising values. Yahoo Finance's Pearce the Romanian has more. This is an interesting trend we're seeing here, Pearce.
Yeah, and a lot of metaphors there in the watch world. But anyway, yes. So BCG and Watchbox with a joint report here talking about how over a 5-year period, this basket of 3 luxury watches, pre-owned Rolex, pre-owned APs, pre-owned Patek Philippe's, were actually returned a 20% return, for that basket versus the S&P 500, which you showed that chart. S&P returned 8% over 5 years. So basically, the big gist of this is that they're talking about how watches, or at least pre-owned watches, are a alternative asset that you should be watching in this world. You know, secondhand watches have been falling in value recently, but they're still sort of very much elevated since the pandemic began. In fact, BCG finds sales of pre-owned watches hit $22 billion in 2021. I expect it to keep rising faster than the new market. So I also want to note the changing demographics of watch buyers. They note there's collectors, there's hobbyists, there's fashion types who want to get into watches at different price points and different models. But what they're seeing, though, is that female or women buyers and also younger buyers are stepping up in the market, getting more and more into watches, which has traditionally been a very older, male-skewed crowd. So that's good to see that. It's good to see for the watch industry as they want to kind of expand.
And I remember we had talked about some of these crypto bros and people who invested in crypto selling their Rolexes, flooding the market with them. So it's interesting to see their value actually increasing here. But let's talk about the cheap and cheerful watchmaker Swatch. They're out with a new collaboration, and it seems like a repeat from last year, though. Tell us more.
Yeah, they teased a couple days ago and then put out the new Moon Swatch, which is a collaboration with Omega. Basically, it's a moon watch that Swatch makes at a much cheaper price point. It uses not a mechanical movement. It's made out of sort of bioceramic plastic. It was a huge hit for whatever reason. People loved the fact that it was like getting an Omega moon watch for cheap, but it's made by Swatch. And this new one here, they call it the gold. It's a gold-covered moon watch here, a moonshine gold as they call it. Has a gold-plated second hand there. Costs a bit, like maybe $25 more than the standard Moon Swatch, if you can even find it, because there was a huge hype train last year on that watch when it came out. Everyone wanted it, so they're kind of doubling down on that with a lower, small release that's only in a few markets. And also the gimmick is that it was made during a full moon, as they say. So that's why this is a special watch. But they're sort of capitalizing on that trend. And apparently, we saw on social media lines again out the door at Swatch stores. People wanting to at these 4 specific Swatch stores across the globe for this watch.
And I love these sort of cheap and cheerful crossovers with these designer brands. I always love to see those. But yeah, they sell out immediately. Great stuff. Yahoo Finance's Price of Romanian. Thanks so much. All right, coming up, results from the Skims' first ever State of Women are out, and the data may surprise you. The company's founders join us to break it all down next. The Skims' first ever State of Women survey shows 83% of millennial women are done letting society dictate what a woman's role should be. And here to discuss how women are rewriting the rules to live their lives, from finances to mental health, we have the Skim co-founders, Carly Zakin and Danielle Weisberg. Thank you, both of you, for joining me this morning. So, Carly, I'll start with you. How did we get to this inflection point in the first place? Was it COVID or was it something else?
You know, first of all, Rochelle, thank you so much for having us. It's interesting. We know that things have not been good for a long time. Certainly, this is a generation that's gone through not just a pandemic, but now two recessions. I don't think that we realized just how bad it was. I think that, you know, we looked at really an action-oriented report that really actually validated what we were hearing from our audience, what we were seeing. And really, overwhelmingly, 83% of our audience is saying, this isn't working. I can't let society continue to dictate how my role should look like, because what's happening right now is not sustainable. The state of women is not good.
And Danielle, I mean, to that point, I mean, we see mental health, the #1 well-being issue on women's minds. How are you seeing that reflected in the sort of decisions that they're making about their life, about their careers?
Well, I think it's really interesting with that. We heard from the women that participated that 1 in 5 of them have had a mental health concern, whether that's depression or anxiety. And that's alarming, yet not surprising when you think about the mental load that this generation has carried. We see it show up in a few ways. This is, you know, really notably true amongst our audience, but especially true amongst Black women, is that 87% of women have or want to create more financial stability. They are thinking about this in terms of what can I do to take control of my situation. There's no longer kind of this myth in waiting for the government or a system or a company or a person to come help. We are making it happen for ourselves. That includes adding passive income streams. It includes investing in their education. And I think that a lot of this in return comes with an acknowledgement and a concern around the fact that there is so much unpaid labor, and we are carrying so much of the mental load.
And so, Carly, to that point then, as people try and balance their mental health while also trying to make up for the wealth gap that women already have, what does this mean in terms of the opportunities and perhaps the support that women need if they do want to venture out and go and start a business or get more raises? How do they turn that into action?
It's a great point, and I think that's, you know, really the takeaway of the report is how do we turn this into action? And I think first is to actually understand the stats. So we look at how do you get informed, which is we recommend going to our website, theskim.com/stateofwomen, where we have all of these stats listed, and you can easily articulate them in both your home and your workplace. The second is really to get loud, and that's not just getting loud to one another, that's getting men to be loud as well. We need everybody to understand that what is happening isn't working. And we need to actually understand it as an economic argument. If we don't help women be supported both at work and at home, we're talking about leaving over $3 trillion on the line. This is an economic moment, and this is an economic danger if we don't address this. And then finally, it's around taking action. And we've seen so many women in our community, you know, through small changes, be able to share small ways that they are actually making changes at home. We have one woman in our audience, her name is Kathy. She's from Queens, New York, and she actually used product management software from her office to split up the chores at home so that she actually was looking at it in the same way she would look at it as a project at work. And so these are just small examples. We're also encouraging our audience to share their own examples using #StateOfWomen on social media.
And Danielle, obviously we're still at the forefront of a lot of, you know, things like generative AI, new technologies in a hybrid work environment, things that give women a lot more opportunities to really expand here. Talk about some of the actionable steps, Danielle, that women can take to really get to the forefront of this and really advocate for themselves and position themselves for the jobs and the careers of the future.
So I think that there are two really important things. And the first part is about speaking up. And the second part is in not speaking up alone. So we've seen, you know, there was a skimmer from Laura from New Hampshire who decided that she was just going to stop saying yes to every request. And I think not only did that shock her family, but I think it also shocked those in her support system around her. And it worked. It really helped giving her time and also having others learn to be be more self-sufficient. We see in the workplace that there is obviously a huge and continued trend since the pandemic for more remote and flexible hybrid environments. And at the Skim, we've definitely heard it and adapted accordingly. So I think the more that you can advocate for those policies that work for you, the better. And that includes things like paid family leave. That is hugely important, and more sources of childcare. There's no way that we can do that, continue to make the gains that we want to see without that. But I would also say, and this is the most important part, this is not a women's issue. This is an economic issue. If we want to make sure that we have people in the workforce, if we want to make sure that we can have a birth rate that increases, if we want to make sure that we can have Social Security to rely on, we need to make sure that women are participants in this workforce. And the biggest way to do that is not to leave out half the population. So make sure to have men call in and call on to get in this with us, to make sure that they too are advocating for these changes and policies, because it's something that's going to help all of us.
It certainly does require a holistic approach. I'm so glad you were able to join us today, Carly Zakin and Daniel Weisberg from the Skim. Thank you for your time this morning. All right, shares of JD.com sliding despite a beat on earnings as revenue for the latest quarter missed estimates. The Chinese e-commerce firm saw a steep drop in revenue growth, reporting a 7% increase for the fourth quarter, down from 23% revenue growth a year earlier. JD.com also cautioning investors that a recovery in consumption could take a while. All right, coming up, we'll have more coverage on Norfolk Southern's Senate hearing later on today. We'll break down what to expect next. President Biden is set to unveil his budget proposal this afternoon. Now, that will reveal his plans on the billionaire tax, Medicare, and Social Security. He's also expected to propose tax increases on investors and high-earning Americans in his yearly budget request to Congress. Now, we'll have the latest coverage on President Biden's budget proposal throughout the day right here on Yahoo Finance. Meanwhile, Norfolk Southern CEO Alan Shaw is on Capitol Hill today to testify before the Senate on the company's train derailment in East Palestine, Ohio. We'll discuss the implications of the crash and the outlook for Norfolk's bottom line with independent railroad industry analyst Anthony Hatch. And National Wildlife Federation executive, vice president, and former U.S. Environmental Protection Agency official Mustafa Santiago Ali. He joins us later today to weigh in on the environmental impact of the crash and the outlook for residents facing exposure to hazardous chemicals. You won't want to miss it. Right, well, let's do a final check of the markets now. We're seeing the markets losing some ground here as we head into the new now, though still in positive territory, but just barely. The Dow up just barely about 2 points now on the day. The S&P just turned negative. The S&P, though, and the Nasdaq still positive. That'll do it for now. I'm Rochelle Akufo. I will see you tomorrow at 11 a.m. Eastern. See you then.